And unbeknownst to me, was having a hard time with all of this information because later I found out she found it to be very bittersweet. She called me and she said, Chris, I thought the presentation was really great until I realized that being a single mom, you know, I only make $100 more than I spend every month. And so it doesn't work for me. And I'll never forget, because my first reaction when she told me that was,
Yes, it does.
no, it wasn't. Remember, there was a process here for me to learn how to teach this, right? When I learned it, I actually stumbled on, I was looking for ways to pay the mortgage off. Remember I told you the whole thing about trying to do something different in the business that nobody else had done? Well, I decided, well, everybody else out there in the mortgage brokering world is helping people into debt. Let me see if I can help them out. And I went on this hunt. I found a book by a guy by the name of Harge Gill, Australian book. Ordered it offline. It said how to own your home years sooner without making extra payments. It was only until I got the book that I realized it was from Australia, and I thought, well, what a waste of time. How different their banking system must be than ours. But actually they're a Commonwealth country, so their banking system's actually quite similar, right? So I studied this guy, and that's how I developed the system. And then when I finally understood it for myself, because it was really difficult to grasp, to get it all, right? Then I was like, wow, how am I going to teach this to people? And there was a lot of things, when I went out there and started teaching it, you can imagine I was taking a chance. Because I had never had it pressure tested against an audience of intelligent people who were going to try and pick holes, right? Because that's what we're trained to do. You're going to try and look at it and go, can't be, it's too good to be true. That's what I was up against. Well, this one woman, she pointed out that it wouldn't work for her. And my first reaction was, that's the hole. I hadn't thought of that. That's the hole. You know, so I went back and I started doing the numbers to determine, here's what I found. Well, it turns out the first $100, so if you only had $100, right, that you were making $100 more than you spent every month. So you are in a tough situation, but you implemented this anyways. So your monthly or your annual payment from line of credit to mortgage would be $900, not $9,000 in that case. Saves her 6 years and $53,000 of interest. That's a lot for $100. And what I learned was, by doing this chart, was that the next 100 only saves her another 2 years and $17,000 more. So actually, because there's less to save, each 100 after the first 100 is less powerful. Now, why that's important for you? Well, 2 reasons. I don't know you, and I don't know your financial situation. You may be that person with only $100 less money. It doesn't mean you shouldn't do it. You should. In fact, you know, that's probably the most efficient you could be. But what it said to me was, when I looked deeper, is I said, wow, so I could figure out who I am in this, and I could say, yeah, I make $1,000 more than I spend every month, but do I want it all to go to my mortgage? Do I want to be house poor? Probably not. I'd like to do some other things, and I'd like to do them guilt-free. So why not look at something like this and say, I'm okay with 15 years and saving $119,000, and I'll keep $300 a month for myself. And I'll go on that vacation once a year, and I'll do it with peace of mind, and I'll sleep well at night knowing I'm going as fast as I want to go, and I've done the work, and I've done the math, and I know the pace I want to go at. It gives you that choice to be able to determine the path you want to be on. So you know that it's a law of diminishing returns. There's less to save, so each $100 is less than the last, and there is a tipping point. There's a point where it just doesn't make sense to put any more money into this system in a year. It just doesn't make sense. So it's good to point that out, and I want you to know this works for everybody. If like, it won't fail you. You know, there's a saying often when the ship hits the harbor, and it's not the harbor's fault.
Is this the same thing you can save money by paying, say, weekly versus monthly?
Really, maybe the biggest myth there is. So paying weekly or paying bi-weekly, what that does for you, it's a convenience trap, right? And if you did the math, what you'd learn is that by making one extra monthly payment per year, you would have the exact same results. But it is convenient for people, and you should do it for that reason, not for, because what the bank does, the bank calculates your mortgage once a month. So if you give them money in the middle of the month, they just hold it. You pay interest on it for the rest of the month, and then they apply it to your mortgage. See? Well, you have to know that. If you didn't know that rule. Thing. So anyways, here's what I want to move on to. So there's another side to our business. I'm licensed to broker mortgages, and my team is licensed to broker mortgages. Means we put borrower and lender together, okay? And we look for win-win situations. In some cases, if you needed a mortgage, I would connect you to an institution and get that mortgage done. In other cases, you may have investment capital, and I can lend it for you in private mortgages to others who need the money, and you can make outstanding fixed returns, very consistent with security, which is an element of investing that not a lot of us have. Do you know what the #1 most popular investment choice for Canadians is? The mutual fund. We invest our RSPs into the mutual fund, but that's the #1 vehicle. It's a $900 billion industry in Canada, okay? And here's the disconnect. If you ask people what's important in an investment, they tell you always the same 3 things. They say security, high returns, low or no fees. That's what they want. And then you look at the mutual fund, and it is the exact opposite, right? Unsecured, high fees, low returns on the average. So there's a disconnect. So the question is, right, similar to why are people banking this way when there's such a better way? It's just because they don't know. Why do people consistently choose the mutual fund?
Because we've been told.
What else do you know? You know, short of investing in real estate properties and buying and renting or buying and flipping or whatnot, it's a very limited scope that the average person feels is available to them. In most cases with the mutual funds, it's not you investing your own money, you're giving it to somebody who you're trusting to invest it for you, and in most cases they're making more money than you are on the fees. But there is a safe, easy way to build a predictable nest egg that will support you as you age. The only reason you aren't participating yet is because no one ever showed you how. That's about to change. So I want to show you the power of private lending. Now I'm not going to get into too much detail with specific lending opportunities today. If what I say makes sense in the next 15 minutes, and you want to continue that conversation, you need to let me know with that card. We're permission-based marketing. I do not chase people. We don't have a sign-in sheet. We're not going to call you for any of that stuff. If you don't fill the card, you don't get a call. If you do, you'll get a call. You'll get a call from me. We'll talk. We'll chat. We'll decide what's right for you, answer all of your questions that you didn't have the courage to ask here tonight. But that's how we play the game. I just do these workshops every day. And we want to, it's attraction. We want to work with people who get it and make sense to them. If it doesn't make sense for you or you're doing something else that's working, brilliant. Keep doing it. But if you're not, right? If you're the person who has been trying to invest for a long time. You know, for me, at 20 years old, my father showed me this card. I'll never forget, it was a wheel. And the wheel showed that if I invested this many dollars per month into my RSP, I could spin the wheel and find out where I'd be at 45 years old, 50 years old, 60 years old, and it was a lot of money. And it just wasn't working out that way, you know? It just wasn't happening, and I think a lot of people are on that train. In fact, I'll share with you a quick story. I had the pleasure of speaking at a big auditorium with a large group of people. There's about 300-400 people in the room, and it was a debate style. So there was me touting the power of private lending against a mutual fund dealer who was involved in and had been very successful. And the question from the audience was, tell us how your style of investing performed over the last 5 years. And so it was really easy for us. I said, well, our returns are fixed and they range from 8 to 12% per year. But like I said, they're fixed, so they're predictable, right? It's the same thing. They're not compounded, they're simple interest, but they're predictable. And so if you did 2000, it was 13 at the time, so if you did 08, 09, 10, 11, and 12 as a 5-year study, you would find at the worst case, let's just do that, it was 8, 8, 8, 8, and 8. If you invested $100,000, you would have $140,000 now. Simple, okay? People are like, okay, nothing really spectacular, but fair. What about you? And this is the first thing that came out of his mouth. He said, well, we average 10% per year if you take out 2009. And the audience was kind of like, well, what do you mean take out 2009? And so of course I had to jump on it. So I said, well, what happened in 2009? He said, well, 2008 we earned 10%, 2009 we lost 30 because it was the recession, right? Everybody experienced it. and then we earned 10, 10, 10. And so I said, well, let's do the math. So what happened was we started with 100, and we went to 110 after year 1. Then we lost 30, and we dropped down to 77. And then we earned 10, so let's just round up from 7.7 to 8. So we're at 85. And then another 10, round up again, 9, you're at 94. And then another 10, so let's round down on that one, you're at 103. And when we got to 103, someone in the audience went, that's my RSPs. Yeah. All right? So, okay, so the idea is, you know, if I told you who is a real great candidate for investing in secured lending, it's somebody in the age category between 40 and 65. Why? Because at 25 or 30, you still think you're impenetrable. You still feel like 8% or 10 or 12 is nothing, and you're going to be doing much better than that. I mean, because you know and your friends know. But when you get to 40 and you start to realize, hey, 65 is just around the corner because 30 to 40 went really quick, right? And 40 to 50 is probably not going to slow down. You start to realize the power of, you know, you start to think of fairy tales you read about the tortoise and the hare, right? And you're like, well, the tortoise kind of knew what he was doing. So at the end of the day, what I'm saying to you is we're never going to be 18, 20, 25, 30% a year. That's not us. But we're always going to be 8 to 12 with consistency, predictability, and the security that comes with knowing you have an asset to back your investment, which is different than what people are normally used to. So I want to spend the next few minutes just teaching you a little bit about how we find those types of opportunities and where they exist. Well, first rule of lending.
Yes.
Don't worry, there's not a lot of slides, as you noticed throughout the presentation. First rule of lending is there's no shortage of borrowers. It's really important to understand that. So I go to work every day, and I run an office, and we keep that mantra front and center. The fact that more will come tomorrow. And it's an advantage in business to know that, because you never feel desperate, and you never feel like you need to put money into anything. You can say no, no, no to 99 out of 100, and our rate is about 5% approval rate, okay, on private money, but the applications just keep on coming because there's no shortage of borrowers. In addition, it's important to note that the default rate for mortgages in Canada is less than 1/2%. That's incredible. People pay their mortgages. They let everything else go before they stop paying their mortgage. Why?
Because that's what
the roof over their head.
Yes.
And that's what we were taught as kids, and those are values that are in our minds. Okay? With lending, you can invest RSPs, cash, and home equity into mortgages. So that equity you're building in the first half, you could use it to lend money. So imagine taking it out of your house and putting it in somebody else's where it's making money. It's what the bank does. If you think about it, how many of you buy and rent properties? Okay, so you'll understand this very clearly. I don't think landlording is bad by any stretch. It's not what I do.
Somebody's living because
Yeah, it's not what I do. As an investment, it can be great. It can also be terrible, like any other investment. But here's my philosophy on it. If I'm a landlord, I have a partner in that venture, and it's the bank, the lender. The lender gives me the money to buy the house, but it's an inequitable partnership in that the bank says, we'll give you the money, you pay us every month, and all the headaches are yours. Okay? So if any headaches come, they're yours, meaning you need to be in that business understanding that it is the hospitality business you're in. You've got to take care of those clients, take care of the properties. If you're not handy, like I'm not, probably not for you, you know, but for those that it works for, it's great. But there's a difference between lending and landlording. And lending is predictable, headache-free. It's not hassle-free, but it's headache-free. Meaning when you have an agreement with somebody and it's backed by an asset that's of greater than the investment, you can set it and forget it. It's like landlording in that you get a payment every month, right? But there's no worrying about the property, worrying about the maintenance and so on and so forth, worrying about vacancy and so on. It's very much predictable. It's the only way that it's better. That said, the returns can also be better when you factor in all the costs. So it's important that you understand the differences. There are no fees, and your return on investment is fixed between 8 and 12% per year. This is important. Yes?
Are these private borrowers or institutional
No, private.
Yes.
developers?
Both. Okay? There are lots of ways to lend money. Yes?
is how, so who can guarantee the security if the real estate, the bubble was broken, assumed broken, and then the bank will take all the properties and resell at low price, and how secure?
Well, you have to consider all of that before participating in any type of mortgage. Just like the bank does their due diligence on every applicant who comes to apply for a mortgage, there's the same process, and that's what I want to take you through next. So you're going to like the next part. So there's a 5-step system that we use to evaluate borrowers and determine whether or not they are appropriate for lending.
Excuse me, I have one question.
Yes.
What's the percentage between first and second mortgages typically that you're dealing
And
with?
interest rates?
No, I mean the kind of mortgages that you are brokering.
Oh, we deal with actually almost an equal weight of first and seconds. We don't do any thirds.
Thirds are too far away. Yeah.
Huh?
Too scary, thirds.
Well, not necessarily, but you just don't need to go there. You
Right.
see, remember when I said there's no shortage of borrowers?
Right.
What's nice about the business I work in is that I can stay right here.
Right.
I can stay here and sift through all the borrowers and just lend to the ones that make sense. And you don't ever have to, and so if I can lend to anybody, right, it's a sifting process, so if everybody in here lines up and half of you are third mortgage, you're looking for third mortgage and half are seconds, well, I can disqualify the thirds right away because there'll be another batch of seconds right behind you. Right, so we don't have to go there. Are there good third mortgages? Probably. Just not our space.
No,
Yeah. Okay. Now, there are people who make a niche out of that,
Yeah.
right? They just do that. And they make great returns. And they understand the power sale process and they're prepared for it and so on. So if there's a plan, it can work. It's just not for us. So no shortage of borrowers. We use a system we call Esther. Okay? Esther's our watchdog. Here's what we do. We look at exit strategy first. Okay, so if somebody comes in, they're well dressed, they look the part, they have a great story, but so does everybody, and they fill out their application, they put it on paper, and we say, nice to meet you, doesn't matter who you are, doesn't matter what you look like, how do I get my money back when you don't pay? That's the question. How do I get my money back when you don't pay? Now, I've been standing up here talking to you for an hour and a half or so, and maybe some of you have already decided, hey, you know what, this guy seems like a trustworthy guy and whatnot. Now, if I just decided to tell you that, you know, afterwards you saw me on the street and I told you that my car had broken down and I needed a couple $100s to get home, how many would you lend it to me? See, so we haven't built that much rapport yet, right? We built a little bit. But what if I said to you, I'll tell you what, if you lend me the $200 to cab it home, I'll give you the keys to my Cadillac Escalade, and you can hang on to the car until I come back and pay you back with interest. How many would give me the $200 then? We got a couple more. And how many of those would likely have the thought in their head, I hope he doesn't come back. I'll just keep the car, right? I'll find somebody to get my $200. So it's all about security, guys. That's all it is. So the exit is, how do I get my money back when you don't pay? And if you can answer that question and the math makes sense, then we can move not into a mortgage, we can move to step 2, okay? But I'm going to show you how fast it is to calculate the exit strategy. It's really simple, it's all mathematics. We have a house that you say is worth $500,000, and you have a first mortgage on it for $350,000, and you want $50,000 of my money in second position. What's the first question I should ask? Why do you want the money? Don't care yet. But it's always the first question, so you're 100% right. That's what people say every workshop. Why do you want the money? Who cares why you want the money?
So how's qualified for emergency?
I told you what the answer to the question is. How do I get my money back when you don't pay? Right? That's what we need to ask. It's all that matters. Nothing else matters until we establish that. So the question is there enough money in equity in the house to pay me back despite having to go through a process of selling it and paying the people that are required to help sell it? So Todor is a licensed real estate agent. Todor, if I put a $500,000 house on the market today, right, how much are you going to charge me to sell it?
5%.
25 grand right off the top. Now, when I have to forcibly take somebody's house and sell it, right? Or take over a house and sell it, I have to hire a lawyer to do that. Lawyers don't come cheap, and if you know a cheap one, please let me know. $10,000. Okay? And Todor, if I want to sell that house, first of all, I should ask you, do you want to sell it today, tomorrow, 3 months from now? Yesterday? Yeah. And if I want to sell the house yesterday, what am I going to have to do with the price?
Drop the price by 5 to 10%.
5%.
5.
Let's be yeah.
5%. By the way, in 7 years, I've never had to go through this process. Okay? 7 years in lending, over $10 million, we have never ever had to go through power sale. The closest we ever came was last month. Okay? On a $265,000 house. And the lawyer, after it resolved itself, and I'm going to tell you, there was a time I thought, here we go, this is our first power sale, we're going to have to hit the button and go do it. Now there's a legal process for this. It's actually quite simple, but it's nerve-wracking if you get into that spot. But there are ways out, and the lawyer, after it resolved itself, I said, wow, you know, I'm really happy that this all worked out the way it did. And he said, a registered lien on title is a really powerful thing, Chris. It's amazing what people will do to make sure you don't get to take their house and sell it. And it's true. Right? It's a big asset, right? I do not want you to drive my Escalade away. Just don't, right? So I'm not going to give it to you. So 25 plus 10 plus 25 is $60,000. It may cost to sell this house. And then I got to pay the first mortgage off. So 350 plus 60 is 410 plus 450, or plus 50 is 460, and we're good. Passes the math, right? That's how you establish exit strategy. If it doesn't work, it doesn't work. If it's too tight, move on. There's another opportunity around the corner. You just don't need to do it. And to your question, do we do private residential seconds and do we do development mortgages? Was that the question you asked? Who asked that? You asked it? We do development mortgages. They're exactly the same, only the exit strategy is different because when you're putting money into the hands of a developer who's building something, value is being created, which means every dollar that goes in creates more than $1 of value, which means you get more secure as you go, not less. In a residential one, the value stays pretty much the same except with appreciation over time. So interesting to note that. That's how we determine exit strategy. Does it make sense? We did it in 90 seconds. It was very easy, simple to do. Okay, number 2, security. Great example. Yesterday, over the weekend, I got a lot of people know I raise money for people, I do second mortgages, and so I get emails from other mortgage agents all the time who don't have access to private funds, but they have borrowers, clients of theirs who need money. So I get an email and the guy wants to finance a horse farm in Grimsby. Beautiful. Okay, so I look at the pictures, it's beautiful. It's worth, I see a full appraisal. Appraisal's very detailed, $810,000 value. They have a $210,000 first mortgage. They want $260,000 in second position. So we're talking about 60%, 65% of the value of the farm altogether. And we said no. Credit was good, borrower looked good, everything was good. Why do you think we said no?
Who's going to buy it?
It passed the exit strategy test. Yeah, it stopped here. And the reason it stopped here is because 3 things. I don't want to own a horse farm. I don't want to operate a horse farm. And I sure as heck don't want to try and sell a horse farm. Which is a limited market to buy it. Who's buying horse farms? And how much of the value is the house? How much of it is the barn? How much of it is the horses and so on and so forth? So it's too complicated. Past beaches that I know, if I even breathe the word sell, it's gone. Right? Probably for over list than I would a horse farm in Grimsby at half of the value. You see what I'm saying? So that's security. Then, after step 2, we get to the borrower. Okay, and this is more a formality than anything else because if we're really comfortable with the exit and we're really comfortable with the security, we're kind of saying to the borrower, hey, you get the rules, right? You don't pay, you know what happens, right? And he goes, yeah. So what we really want to find out here isn't what you might think. Most people think that what we're looking for is somebody with great credit or someone who doesn't have terrible credit. I really couldn't care less about the credit per se, but I do care about other things like, does he owe money to the government in income taxes? I want to know that. You know why? Because the government can come between me and any property if somebody doesn't pay their taxes. I want to know that the property taxes are up to date. And if they're not, that's okay, but we're going to bring them up to date, right? And maybe we're going to hold back some money to make sure they're paid throughout the term. I want to make sure the home insurance is in place, right? I want to know that the home insurance doesn't expire before the maturity date of the mortgage. These are common sense things from where I sit. But if no one ever told you, you just wouldn't think about those things. Because when you think as a borrower, you know, you're not thinking as a lender, right? It's different. It's funny how many people will call me when they're arranging their own first mortgage with a bank, and the bank asks them for a laundry list of paperwork and whatnot to back up their application. They say, why do they need all this stuff? And my answer is always the same. I say, what if it was your money? What would you want to know?
What did that go?
Right? It's different when you're in the lending position than when you're on the borrowing position. But in fact, the evaluation process is very, very simple. It's actually extremely simple. It can be done in 15 minutes if you have all the right pieces. If you have an appraisal, if you have a credit report, you tell a lot about somebody. And there, sometimes when we go, so I go to see the property, I go to meet the people who are borrowing. It's amazing. I've been talking to the husband the whole time on the phone, and then we sit down at the table and the wife is there too, and they start talking, and they're not talking the same story. Right? That's a pass. That's a pass. Something's wrong. I don't like it. It smells wrong. We pass. Right? So it's a human business, and why I say that to you is because there's a difference in our business between, like, based on who you deal with. It really does matter because there's lots of guys out there with a license to broker a mortgage, but not a lot out there with the license to do it right. Okay? Because most guys are just in it for a fee. But that's your borrower evaluation. Then you get into terms. This is a really key one. Because a lot of new lenders, they get really excited. Because when you tell somebody they can make 8, 10, 12% consistently, and it feels like easy money, they say, hey, I heard from my friend that I could charge whatever I want. I could charge 16 or 18%. And I say to them, and what's the thing you don't want to have happen the most? And they say, I don't want the borrower to default. So why put them in a position to default? Right? Why be greedy? It's a win-win. He has circumstances. His circumstances are not necessarily bad. We did a second mortgage this week for a couple who had a tree fall through their house in last winter, and the insurance built them a whole new house, but would only give them enough money to build the house. They wouldn't give them enough money to furnish the inside and do it right, all the stuff that was damaged inside. So they needed a little bit of money. This is a couple who earns between them over $300,000 a year. Great people, done the first mortgage for them. They can pay the second mortgage back in less than a year, but they need help to get through this, and they're willing to pay 12% on that money for a short period of time. It's a win-win. But if a lender comes in and says, I want 16%, well, you put that whole deal in peril. So it's important not to be greedy as a lender, be reasonable. I mean, when was the last time your portfolio made 8% or better consistently for 2, 3, 4, 5 years straight? That's what happens when you lend money, if you do it the right way, if you're patient, and if you do it by using a system, you know? If you apply a system to the way you build equity in your house, you will build equity fast. If you apply a system to the way you lend your money, it'll be great. You'll do a great job. If you're sloppy, you'll probably get burned. If you're sloppy with your own building equity, you won't build equity, right? It's very simple, okay? And the last is return on investment. And here's what I'll say about return on investment. And I have shortened this part just because of time. A return on investment will be there if 1, 2, 3, and 4 check out. That's it. It's that simple. Lending, people ask me all the time, why doesn't everybody do this? It's the same question people ask, why do people pay their mortgage down like this? And it's just because those who do it don't talk about it, because it's great. And there's actually less quality opportunities to lend out there than there is money to be lent. We own 66% of all the equity in all the real estate in the country, and there just aren't that many quality borrowers. I always in our office, we have a list of people waiting to lend money, right? And we never have enough opportunities to lend it. And we have to be patient. And you have to be patient. So if this is something for you, I'm going to tell you now, if you fill out that card and you say, I want to do the investment part, I will spend all the time I need to educate you. My team will take time to educate you properly, show you everything you need to know. You have to be patient. If you put downward pressure on us, right, to put the money out tomorrow, and we have no choice but to put it into silver or bronze or worse deals, right? But we won't do it. So I'll turn you away, and there's lots of guys who will. Tons. low barriers to entry in the mortgage brokering business. You can be doing whatever you do today, and a week from now, if you can just pass a test of 100 multiple choice questions and get 60 right, after 5 days in class, you could be up here doing what I do. You can be brokering mortgages. So you got to be careful out there who is brokering mortgages. Somebody puts a one-page mortgage agreement in front of you, it's not good, right? Check your own paperwork on your own mortgages. It's never one page, right? There's work, there's effort, there's time that goes into it. If you want to lend money, it's really profitable. Your RSPs, my gosh, like RSPs making 8 to 10% per year, every year until you're 65. Do the math when you go home. You'll be really happy. But there's a process to doing it. There's a system to doing it right. So it's not come to the workshop today, lend tomorrow. It's come to the workshop, get educated, get your questions answered, and then get involved in lending at the right pace over a period of time.
So if you get a mortgage from like a bank, right?
Yeah.
Or anybody, the bank will pay you the fees. So in this case, do I pay you the fees as a lender?
We charge the borrower.
You charge me. Okay.
You never pay a fee, ever,
And is there a
ever.
okay? Good
Just
to know.
want you to know.
Now, is there there's a lender's fee also? Is that included in the 8 to 12%?
Yeah, there can be lender fees. On certain deals, there can be lender fees. But a lender fee is, I mean, at the end of the day, what we look at is total cost of borrowing. Okay, so if I say to you as a borrower, you're going to pay 9% interest and 4% lender fee, it's no different than saying 13% interest and no lender fee. Okay, the difference is that the lender gets that money up front.
Yeah.
And the payments are cheaper for the borrower along the way as a result, because they're only paying 9 instead of 13. So deals are structured in such a way as to create the right scenario for both parties. In some cases, it may make sense to charge a lower interest rate so that the borrower has a smaller payment per month, and that makes sense. In other cases, there's no extra money to pay that lender fee, right? Because the lender fee comes out of the money that you're lending, right? It's just held back. So you lend 100,000, but you advance 95, right? That's how a lender fee works. So at the end of the day, each deal is structured in the way that makes the most financial sense for both parties. These are win-win scenarios, okay? And one of the most popular products that we have, especially for RSPs, is what's called a syndicated mortgage. Has anybody heard of it before? Syndicated mortgage? Syndicated just means multiple lenders for one mortgage. These are the mortgages for developers. They're extremely safe. The equity is being created with every dollar that's injected into the mortgage. They pay 8%, and then the developer usually pays you a profit sharing bonus at the end as well. So your average returns are around 10, 11% per year at the end of the day. They're great for RSPs because RSPs, you don't need them to be liquid, right? You can afford to give them to a developer who's building a subdivision that takes 3 years. Whereas if you're lending cash, you'd want to be in probably private residential second mortgages where you're getting paid every month and you can get out every year. Once a year you can get out. So you have liquidity, right? One of the other things that we do that's very different than everybody else is we add a diversity element into lending. Meaning, if you say to me, I have a portfolio of $300,000 of RSPs, we're not going to take the $300,000 and find one mortgage for you. We're going to break it up probably into 5 or 6 different mortgages. So you have layered security. Security on each mortgage, but layers of security. And we're probably going to find you mortgages, development mortgages, some in Ontario, some in Alberta, some in Manitoba, to be market proof as well. Some with a 2-year term, some with a 3-year term, some with a 4-year term, so that all the money isn't maturing every year. Right, so all these layers go into it. That's a lot of work for us. It creates a lot of paperwork for you. Probably the only reason why most people don't do it is because it's a lot of work. But it's how you should. It's how you should behave in the lending space. No question, is diversify your money. The minimum?
Yes, yeah.
The minimum investment is $30,000. We will do a private residential second mortgage for any amount of money. It just doesn't usually make sense for the borrower to borrow less than $25,000 or $30,000. Right, because the fees and whatnot, it's too much. It doesn't make sense. So you don't find a lot of those. Occasionally they come up, very seldom, okay? So at the end of the day, I just want to bring you back to, you're not going to lend money with us and get rich overnight. You're just not. But consistency is a huge piece of what we do. And if you're not or haven't in the past earned 8 or more per year, until you find something better, it's a brilliant place to be. And you'd find that people who are involved in it are really happy, sleep well at night. Yeah. So, and it's very headache free. Yes, Todor.
I'm one of those people.
Oh. Yes, Todor is, what's that commercial? He's not just the president, he's a client. Yeah, so questions that you may have that pertain to your own situation, you just have to let me know you want to get those answered, and then I'm happy to spend the time that it takes to educate you. You won't get any pressure from anybody on our side. Like I said, we have a waiting list of people wanting to put money out and not enough deals to fund them all. It takes usually 60 to 90 days to get everything out if you have a large sum, unless you're participating in the syndicate space, which we always have a shelf of product that we can put money into, which is great. So if you're getting started in it, it's RSP money, brilliant.
What's the minimum RSP?
30,000. Okay, and we typically break the money up in amounts of 30. So if you have 100,000, we'll give you 2 or 3 projects. If you have 150, it'd be 4 or 5, and so on and so forth. What's on the screen? Okay.
This was great.
Thank you. You know what? I've been doing this a long time. I never get tired of it. I enjoy doing this. And I'll tell you why. It's because I come from the place of not understanding money, and this is what I do. And it's worked really well for me above all else. So it licenses me to actually talk passionately about it because I'm a product of it as well. And I can tell you this, and Todor I think can back me up on this. If you do business with us, we're never going to be a monster brokerage. We're always going to be boutique-y, and it's because it's all personal. It's very personal. We don't look at anybody's money any differently than our own. And anybody could stand up here and tell you that. But we will take the time to make sure you understand what you're doing and that you're doing it with peace of mind. Because if you do anything investment-wise without peace of mind, why are you doing it, right? What's the point? Because stress kills more people than Big Macs, yes? Yeah, so, and we have enough stress in our lives. So I appreciate you guys giving me the chance to do this. Natalia, amazing room. Really nice, right? Really nice room. Sorry to interrupt you, but really great room. She did a great job getting you guys here. You wouldn't have got to see it if she didn't, because I had nothing to do with that. So I appreciate it. Thank you so much. And this is how it works for me. I only go where I'm asked to go, and it seems to keep happening, which is really good. So I appreciate you guys being here. It gives me a chance to do what I love the most. So thank you. Okay?